Hey guys, welcome to the Silver Report Uncut. I have a little news update. We're back on to Telegram. My access has been restored to Telegram. Make sure to follow us there on our channel. It's t.me/Silver Report. Also, I wanted to thank all you guys who help support the channel, who help bring you the Silver Report Uncut. If you wanted to lend a hand and to help support me and the channel, there's some options in the description where you can do that. And I thank you guys also who joined into Buy Me a Coffee, which is like a monthly subscription similar to Patreon, except for it's not Patreon, where you can donate and help to continue to make sure that, ads or no ads, no matter what we do and what we face coming through, that we will still be able to continue this operation, keep it coming. And I thank you guys so much who have supported us there. We're also brainstorming some ideas because I'm going to begin to release some ebooks. I have some ebooks I wanted to release. They're going to be for sale. Maybe on Buy Me a Coffee, I was thinking we're going to give those out for free to the people who are our supporters and who are helping us out. So if you're one of those people out there, that's some good news. So I'm still working that out and ironing out the details about how that exactly works, but it's an interesting part of the platform. So follow us, check the description, and let's get busy. I wanted to go over the Fed's latest Senior Loan Officer Survey. It showed some shocking findings, as one would anticipate from the recession, in some cases the depression. But the banks are reporting stricter lending requirements and declining demand for new loans in almost every category across the board. Nowhere more than in mortgages, both for qualifying, non-qualifying. Demand has plummeted to depression levels as a consequence of the fastest recorded rise in interest rates, and it could get worse from here on out. The C&I loans, they continue to perform well, but demand for credit card debt remains near record highs, to be expected at a time when revolving credit debt is soaring at the fastest rate in history. And a lot of the points is that people are getting out new credit cards in order to cover for what they've already borrowed. It's that bad. They're almost out of room here, and they continue to need to borrow to continue to propel themselves just to survive. But the record APRs, they are being ignored entirely, and it's only a matter of time before these two core credit categories follow mortgage loan demand into this descent. At which point the U.S. economy will be a total and complete disaster. There's some further information that came out from Goldman Sachs as they detailed just their thoughts on this. Quote, lending criteria for commercial and industrial C&I loans were tightened in the third quarter of 2022. 39% of banks tightened lending conditions for big and medium-sized businesses on net, versus 24% on net in the previous quarter, a major rise. On net, these are some big moves. 25% increased net spreads for small firms, versus uncertain economic outlook was noted as a factor by all banks that tightened lending requirements or conditions for C&I loans or credit lines. 61% cited a decrease in risk tolerance. 59% cited a worsening of industry-specific problems. 39% cited decreased liquidity in secondary markets for these loans, and 26% cited less aggressive competition from other lenders. 20% they cited a decline in their bank's current or expected capital position. That's scary. 20% cited a decline in their bank's current or expected liquidity positions as factors. Now, I wanted to touch on a couple of those points right there because that's very alarming. The risk tolerance, banks are getting concerned about their stability. They're getting concerned about how long this recession will last, what could be the exact damage, and how their firm's going to hold out. Also, the decreased liquidity in the secondary market for these loans, there's a lot of investors no longer wanting to dip into these loans. They're not backing them. So they're not having the funds to be able to come through and to provide this lending. And if you're unaware by now, the entire economy, it revolves around credit. It revolves around credit. It's necessary for it to continue moving. And as the Fed is attempting to do, they are killing off the demand, meaning they're choking off the supply of money. Now, we also see the worsening of industry-specific problems, and overall, their capital position. That's one of the more concerning ones, that 20% are worried about the amount of money they have, the amount of funds they have to be able to go ahead and to lend this out, and the liquidity positions goes hand in hand with that. The demand for the C&I loans from big or medium-sized businesses fell in the third quarter. In the previous poll, 24% of banks reported increased demand for C&I loans for big and medium-sized businesses. 9% reported decreased demand. 22% of banks reported lower demand for C&I loans for small businesses compared to 18% who reported higher demand in the previous quarter. Commercial real estate credit standards, they strengthened in 2022 in quarter 3. On net, 58% up 10 pp of banks, they tightened credit conditions for construction and land development loans, while 40% tightened lending standards for loans secured by multifamily residential properties. The proportion of banks reporting tightening requirements for loans backed by non-farm, non-residential properties rose to 53%, which was up 11 pp. Loan demand for multifamily residential properties, non-farm residential assets, and construction and land development loans, it all fell as a result of these tightening requirements. We do know the mortgage credit criteria, it's tightened somewhat. The non-jumbo, non-GSE eligible, it was down 3.4 pp to negative 3.4%. The GSE eligible was flat at 1.7%, and mortgage standards loosened marginally and remained essentially constant. Meanwhile, the qualified mortgage jumbo was 0.1 pp, negative 0.1 pp, to 5.2%. The non-qualified mortgage jumbo was 3.8 pp to 7.4%. The non-qualified mortgage non-jumbo, it was up 3.8%, and the subprime residential mortgages, it was up 11.1%. The criteria, it tightened. And that's huge because how is the mortgage crisis going to get any better? How's the housing crisis going to get any better as they're tightening the requirements? It's only going to get worse. Let alone the unaffordable interest rates. It's just the fact that they know Americans can't afford it. They anticipate they're going to default and they're not going to be able to continue to pay on these loans. So they're not putting it out anymore. They're reaching the stage of panic. And this is the banking industry. That is something that everyone should be aware of, especially now that we have those bail-in laws. I mean, we talked about this. It necessarily has to happen. They don't pass laws like that for no reason, where they can confiscate all of their depositors' funds as if they were their own. I'll give you more on that in another video again, and some breakdown on that. But the criteria has been tightening. The bank's readiness to issue consumer installment loans, it fell in the third quarter, negative 7% on net versus the plus 5% that we saw earlier. The proportion of banks tightening credit conditions for credit card applications grew, up 19 pp to 19%. 2% of banks tightened standards for vehicle loans, that was flat, and the percentage of banks reporting higher demand for credit card loans fell, but remained positive at 11% on net. Demand for vehicle loans, it also fell, negative 28% on net, so people are not in the mood. They're not in the market for autos right now, so beware. Aside from the loan supply and demand, the survey's punchline is that the possibility of a recession in the next 12 months was given a probability between 40 and 80% by the majority of banks, with no bank estimating a probability less than 20%. Although banks in general assigned very high odds to a recession developing in the next 12 months, most banks said that if a recession occurs, it would be light or moderate. Furthermore, most international banks predicted a recession within the following 12 months with a chance of 40 to 80%. It's quite shocking that they're all tightening up their lending standards. They have this unwillingness to lend out. All of their backers and their big institutional investors that normally back these loans, they're pulling out, and they still think that it's a very, in my opinion, it's very low. But these banks, on average, some of them deal with investments. They don't want to alarm their investors or tell people that they should pull their money out of stocks. And of course, stocks are not doing bad at this moment. There was a huge short squeeze that came out because the CPI data, it came in lower than anticipated. But JP Morgan, they had an interesting comment that they were not going to be jumping in just yet because they think that there was a lot of holdouts, that the moves were irregular, and that there could be some more shocks along the line. Now, whether or not the inflation data moves or doesn't move, or if it goes higher or doesn't go higher, the simple fact is the consumers are already on their last leg. Obviously, they need more. They need more money than they have. They're having a hard time keeping up with their loans. There's all of these loans falling into default, but they can't borrow anymore. The banks are tightening up. So from here on out, who knows what could happen? I know that with people out there doing the buy now, pay later just to buy pizza for their meals, it makes you wonder, what are they going to do for the next meal? When we have this kind of situation, it's a crisis. It's a crisis that has only begun to bloom because this has been a long time coming. Except for this time, there's no Federal Reserve to come in. The markets love it. Oh, the Fed's going to bail us out. What are we going to do when the dollar is worth nothing? What are we going to do when these banks begin failing? I thank you guys for stopping by and joining us. As always, stay free.